Here's what you may have missed last week in markets. Before we dive in, make sure to follow our page to stay up to date with the latest market news and financial planning trends here in Canada. Markets closed the week on a positive note, with major indices up about 1 to 2% on average. Markets showed that they are resilient, even with a wave of global developments. Last week, there was continued tension between the US and Iran, with both sides exchanging strikes and accusing each other of escalation. The US intercepted missiles targeting warships in the Strait of Hormuz and responded with strikes on Iranian military sites. Despite this, the ceasefire remains technically still intact, and markets didn't respond the way you might expect. Oil prices have pulled back quite a bit. Oil has dropped roughly $25 from its peak, near $120, and fell about 7% just last week alone. This is important because lower oil prices help ease inflation pressure, which is generally positive for the markets. We also saw a notable legal development in the US. The Court of International Trade ruled that the administration cannot impose a new 10% global tariff, following an earlier Supreme Court decision. The court found that these tariffs didn't meet the legal threshold, as they weren't passed through Congress. Markets responded positively to this as well. Less uncertainty around trade policy tends to support business confidence and economic stability. A big focus last week was jobs data out of both the US and Canada, but we saw two sides of that coin. In the US, the data was strong. The economy added 115,000 new jobs, well above expectations, and the unemployment rate held steady at 4.3%. This reinforces the idea that the US labor market remains strong even with ongoing uncertainty. We've now seen 2 consecutive months of job gains, something we haven't seen in nearly a year. This points to still being in a no hire, no fire economy, where companies are staying cautious, but not aggressively cutting jobs either. And markets like this, because for the Fed, it reduces the urgency to cut rates quickly. Right now, markets are pricing in about a 75% chance that the Fed holds rates steady throughout the end of the year. In Canada, the story was a bit different. Unemployment rose to 6.9%, coming in above expectations. We're starting to see signs of softness in the labor market here. Wage growth is still relatively strong, but it's more concentrated amongst higher earners and not broadly spread. This creates a bit of a balancing act for the Bank of Canada, because weaker employment can push rates towards a cut, but inflation pressure and global uncertainty may make them more cautious. Again, this shows how data-dependent central banks are right now. At the end of the day, the biggest driver in markets right now continues to be earnings. Almost 90% of S&P 500 companies have reported, with about 85% of those beating expectations. And earnings growth is tracking at roughly 28% year over year. That's the strongest growth we've seen since 2021. And importantly, it's not just tech. We're seeing participation across financials, industrials, energy, materials, and more. Earnings are what have been driving markets higher. So seeing that growth spread across multiple sectors is a very strong and healthy indicator. This is a great reminder of how important it is to stay invested during times of uncertainty. We saw a very quick recovery after a pullback, and missing moves like that can have a meaningful impact on your long-term return. The biggest risk right now for many investors is staying on the sidelines. This week, we're looking ahead to US inflation data on Tuesday, which will be an important piece for interest rate expectations. But if volatility had you questioning your portfolio, it's a good time to check in and see if your strategy still makes sense. Reach out for a second opinion today.